Warren Buffett's 1978 letter to shareholders isn't just history. It's a blueprint for anyone who wants to become a smarter, calmer, and more effective investor. These 15 lessons will sharpen your focus, cut through financial noise, and show you how to build wealth the Buffett way, with patience, clarity, and conviction. Lesson 1. Look through GAAP, not at it. Accounting reports often look clean and polished, but that doesn't mean they show the full truth. Buffett explains that GAAP accounting forced him to combine companies Berkshire only partially owned, making the numbers look bigger but also misleading. Internally, he never uses these reports. Why? Because they don't show the real economics of each business. Takeaway: segment the business, adjust for ownership, look beyond the format, into the function. Lesson 2. Underwrite with discipline, profit follows selectivity. In insurance, writing more policies isn't always better. Buffett praised his team for earning $11 million on $90 million in premiums, because they said no to risky clients. Chasing volume, especially in commoditized industries, leads to regret. Discipline and selectivity, that's what builds profits. Takeaway: only take the bets where the odds are clearly in your favor. Lesson 3. Only buy what you understand. Buffett's rule: never invest in what you don't understand. He used 4 filters. The business must be simple, have good long-term prospects, honest management, and a fair price. Many pass the first 3. Very few pass all 4. And if it's not clear, he passes. Takeaway: deep understanding is your advantage. Guesswork is just speculation. Lesson 4. Ignore market predictions. Focus on business value. Buffett never tried to predict the market. Instead, he focused on finding businesses that would grow in value over time. Even when the Dow dropped from 852 to 805, he kept buying. Because the fundamentals were sound. Markets swing, real businesses grow. Takeaway: forecasting markets is a distraction. Value is your North Star. Lesson 5. Buy partial interests in great businesses, even passively. Buffett didn't need to own or control Safeco or the Washington Post to benefit. He simply bought shares at bargain prices and let great management do the compounding. Control isn't the goal. Ownership is enough when the company is outstanding. Takeaway: why buy the whole cow when you can get the milk at a discount? Lesson 6. Retained earnings can beat dividends. Most investors only count dividends as income. Buffett says, think bigger. If companies like Safeco retain earnings and reinvest them at high returns, shareholders still benefit. You don't need the cash. You need the compounding. Takeaway: a well-used rupee reinvested is worth more than one paid out. Lesson 7. Capital allocation beats business type. Buffett admitted that textiles weren't great, but he used their cash flows to fund See's Candies and other stars. A business might be average, but if the capital it produces is used wisely, the results can be exceptional. Takeaway: it's not just about what you earn, but where you reinvest it. Lesson 8. Owner-like managers are rare gold. Buffett praised managers like Ben Rosner and Gina Begg, not just for results but because they thought like owners. They didn't need stock options to care. They took pride in the work, and it showed. Takeaway: back people who act like it's their own money, because to them, it is. Lesson 9. Float is powerful, quiet leverage. Insurance companies collect premiums up front and pay claims later. That cash in the meantime, Buffett called it float, and invested it. Done right, float is like a free loan that compounds returns. Takeaway: float is leverage, without interest. Use it wisely. Lesson 10. Be willing to hold, not just buy. Buffett was happy to hold great businesses, even if the stock price didn't move. He wasn't chasing a quick revaluation. He was planting seeds and letting them grow. Takeaway: the market pays the patient. Let time do the work. Lesson 11. Market inefficiency rewards rationality. Berkshire bought companies below book value, while others overpaid for bad acquisitions. Why? Because the market is often irrational. Buffett stayed calm and rational. Takeaway: market mistakes are gifts, but only if you're ready. Lesson 12. Avoid the institutional imperative. Institutions tend to copy each other, even when it doesn't make sense. In 1971, pension funds went all in on stocks. By 1974, they fled. Buffett, he bought when others were scared. Takeaway: don't follow the crowd, follow logic. Lesson 13. Margin pressure is built into some industries. Textiles were hard, high capital costs, low pricing power, and constant competition. Buffett said it clearly. Great managers can't save a bad business model. Takeaway: choose the right battlefield, don't fight the industry. Lesson 14. Past success doesn't guarantee the future. Berkshire earned 19.4% on equity in 1978, but Buffett said, don't expect that again. The insurance cycle was turning. Being realistic wasn't pessimism, it was preparation. Takeaway: respect the past, prepare for change. Lesson 15. Concentration isn't risk, lukewarm bets are. Buffett didn't spread bets thin. He concentrated on businesses he understood deeply. Why dilute your best ideas to include average ones? Takeaway: if you know what you're doing, do it big. Buffett's 1978 letter is proof that timeless investing doesn't need trends or tactics, just clarity, courage, and common sense. If this helped you think long-term, like, share, and subscribe. Because in a noisy world, timeless still wins.